RSPs versus TFSAs. I'm calling this the ultimate showdown. And I don't think it's the ultimate showdown because as I started doing this, I realized there's like literally infinite different variables that you can tweak and infinite scenarios that you could look at when trying to make a decision on RSP versus TFSA, right?
Can you say what you sent me the number of scenarios that it would be if you looked at everything? You like multiplied a couple numbers to get
if I looked at the things that I originally wanted to look at, and since I sent you that message, I've thought of another few scenarios which would make it even crazier, but it would have been 72 different scenarios that I would have had to look at because what I originally wanted to look at was testing, kind of finding the break even on RSP versus TFSA contributions, holding a bunch of things constant. And the reason I was looking at this is because, again, I'm a huge fan of RSPs. I think they're a lot more powerful than people give them credit for. And if you look at common wisdom or rules of thumb online, or even I hear it from advisors, I hear it in online forums like personal finance subreddit, generally what you'll hear, is that $60,000 to $70,000 of income is where the RSP starts to take over the TFSA in terms of where your contribution should be put in terms of the priority, right? So RSP wins if your income is over 60 to 70,000. TFSA wins if your income is below that. I've even heard one very well-known finfluencer say that it's like 120,000 is the break even. Not sure where that came from, but I wanted to take a look at it. And the reason that I've always thought that's not necessarily the case is when you look at taxes on the way out. So in retirement, when you have an RSP and you're pulling taxes out, you often have opportunities for things like income splitting with the spouse, because RIF payments, an RSP becomes a RIF, a registered income fund eventually in most cases, and that qualifies for the pension income splitting. You also get a pension income tax credit, which isn't huge, but it's like, depending on your province, $400 to $450 in some cases of tax saving every year. And as I've argued before, and I'll get into this, RSP returns, like the investment returns, are also tax-free if you hold things constant and if you think about it the right way. And I get a lot of flack for this, even from other advisors, but I'm doubling down on it, and I'm going to get into that in a minute.
So this is what you really think about, eh? This just kind of rolls around in your head?
Yeah, I guess. Yeah. Well, I spent so much time writing the book, and I had and there's some other ideas for things that I want to take a look at later, but this thing, because we have access to conquest planning, and because conquest planning is so detailed and so in depth, I think I realized that, conquest is the way to do this. Because if you Google RSP versus TFSA, you're going to find some really great analysis out there, but a lot of it is just done in, say, Excel. A lot of it is really not much better than napkin math, because it's very, very difficult to quantify the value of certain tax deductions and tax credits over long periods of time, especially when you account for things like inflation and income splitting. The basic personal amount, which is an amount that all Canadians can earn before they end up paying taxes, and needing to inflate that at certain levels. And so really the way to look at this is, let's take a real scenario where we can use some pretty advanced software to project it, and it's not a black box. We can go and look at every single year of tax returns if we want in a tool like Conquest to really look under the hood and see what's going on. And so it's going to account for things that a lot of, I think, the research out there doesn't account for already. And so that's what. And
I just want to say real quick that some of the stuff that we've had to build internally to answer questions like, do IPPs make sense for people with corporations? It was the exact same thing, where you need to have a comprehensive model to do anything like that. And Conquest has that. Like, to your point, Mark, they've done such a detailed job in their tax model and their government benefits model. It's incredible to have a tool like that to test different scenarios.
Yeah,
it's just,
exactly.
Just too complicated to do it back of the envelope.
You can't. You can't.
No, there's so much going on that to do that all yourself, you may as well build something like a tool like Conquest. Like there's so much work that goes into it that like Excel's just not going to cut it, So yeah, so that's what I was thinking about. So I originally wanted to test a few scenarios. I wanted to test $60,000 of income for somebody as like my starting point, because that again is fairly common wisdom. Yep. And take a look at that and then compare that scenario with an RSP and a TFSA, then do $100,000 of income, then do $150,000 of income. Obviously, I would think that the RSP would just continuously get better and better. And then I wanted to look at a scenario with a spousal RSP. So a case where we have one spouse earning $100,000, let's say, and then the other spouse earning zero, and then bring their income up over time and test a spousal RSP scenario, which is an income splitting tool, and see what that looked like. And so I started doing this with the $60,000 income for kind of a mock client that I created in Conquest's planning software. And it looked really, really good. The $60,000, the RSP won versus the TFSA. And it won by such a large margin that I was quite confused. And so I'll get into why that is and how that all happened. But before I do that, I want to explain why I set the scenarios up the way I set them up. So I've made the argument, Ben, you've made the argument, other smart tax people have made the argument that you cannot compare the same dollar contribution to an RSP versus a TFSA. So if you are, for the sake of the example, in a 50% tax bracket and you have $10,000 to contribute to one of the two accounts, you can't compare just contributing $10,000 to an RSP versus $10,000 to a TFSA. And the reason is that the TFSA is a post-tax contribution. You earned your income, you paid 50% in taxes, you were left with $10,000 after tax, you contributed to the TFSA, and you'll never pay tax again on that income. With the RSP, you need to earn $20,000, pay 50% tax to get the $10,000. But if you're making a contribution to the RSP, then it is a pre-tax contribution. You have to gross that up, right, to think about an equivalent contribution to the TFSA.
It's something that's pretty hard to think about. The way that I found to be easiest to think about it is instead of thinking about the after-tax amount first, which is intuitive because people receive after-tax dollars from their salary, like your income taxes are withheld at source for most people. But I found the easiest way to think about it, for me at least, is to just think about the pre-tax amount as the starting amount. So instead of the $10,000 after tax, you start with $20,000 before tax. And like the only time that this is actually practically true is if someone has like a corporation and pays themselves out a bonus and doesn't withhold any tax, then it actually works that way. In most cases, it doesn't. Although in some cases, you can have an RSP contribution off of payroll from your employer without having any taxes withheld. I do that for my own contribution. But anyway, you think about the pre-tax amount first, and then the post-tax amount is what goes into the TFSA. So in your example, you have $20,000 of pre-tax income. So the same thing you said, it's just a different order, I guess. Mm-hmm. You start at $20,000 of pre-tax income. That can go directly in the RSP. But if you want to put it into your TFSA, you have to pay the 50% tax rate. So you've got $10,000.
Yep,
exactly.
That's exactly it. And if you do that comparison, then the RSP is tax-free in the same way that the TFSA is, right? You've got $20,000 starting in the RSP versus $10,000 starting in the TFSA. If they both earn the same rate of return and you pay 50% tax on the RSP when you withdraw it versus no tax on the TFSA when you withdraw it, you end up with the exact same figure after tax.
And that makes many heads explode.
Oh, that blows people's
mind. That could be the key takeaway from this whole conversation.
Yeah.
But they are the same.
They are the same if you hold tax rates constant and returns constant. It's easy to hold returns constant.
And portfolio constant.
Yeah, exactly. Yeah, if you have the exact same portfolio earning the same returns. I think there are valid arguments that, tax rates are going to change. But the thing is it's very, very likely that your tax rate will be lower, in my opinion, in retirement than it is during your contributing years. A, because you have no more employment income. You're not working anymore, so you're starting with a lower base amount of income. And B, because of things like the pension tax credit, the age credit, income splitting availability. So the argument then usually jumps to, well, what if the government increases marginal tax rates? And it's like, sure, they might. But Ben, you've talked about this in episodes, and we talked to Professor Kevin Milligan a couple weeks ago, and like tax rates haven't really changed all that much over the past few decades for most Canadians, like the marginal rates. They've introduced new tax brackets, but the probability of your taxes going from 50 to 70%, like the marginal rate, I think is pretty low, but there's uncertainty there, no doubt, right?
If you look back far enough, there's been some pretty drastic tax changes, particularly for high earners. But yeah, I mean, in recent history, it's been fairly stable. Although I guess with the recent capital gains tax change, that could be seen as I guess that's for everybody though, but yeah, that could be seen as a big jump in tax rates, depending on the type of income that people are earning.
Yeah, no, fair enough. So
I just want to jump in for one sec. So that if if you hold the tax rate constant, like you use the 50% example, the RSP and the TFSA give you the exact same outcome. But again, to think back to the episode with Professor Kevin Milligan, he talked about how measuring income tax is really hard because you can't just look at your personal tax rate. You have to look at government transfers and benefits and stuff like that, which is what you're talking about, Mark.
Yep.
And so it can get really, really complicated, which again is why we need something like Conquest to say, what is your tax rate at contribution and what is your tax rate at withdrawal?
Yep.
You can look at the tax rates, but it's an incomplete picture. So you have to account for all the stuff that you've accounted for in your modeling.
And so here's the other thing, and I haven't fully bought into this theory yet. I think I've got a middle ground that'll work, but I've heard some people I respect say that you contribute to an RSP at your marginal tax rate, right? So you get a deduction off the top of your income, and whatever your tax refund is based on your marginal tax rate, the top tax rate. But when you withdraw from an RSP, you're taxed at your average tax rate, not your marginal tax rate. And the thinking here, and I can see you already cringing about this, Ben, but let me explain the thinking at least. In retirement, if you have multiple sources of income like CPP, old age security, a defined benefit, and an RSP, why are you selecting the RSP in that stack as the one that sits on top of the other income? Why aren't you looking at the RSP income first as the income that's taxed at the lowest bracket, and then your CPP is taxed next, and then your OAS, and then your defined benefit plan? Again, I'm not fully bought into this. You're cringing hard. I can see that.
But why wouldn't you make the same exact argument for at contribution? Why is the RSP the last?
Because that's how the deduction works, right? It means you're deducting it from your income, which is being taxed at the top bracket. If I make $200,000 and I make an RSP deduction, I'm losing the top $20,000 in income for that deduction. So I'm getting taxes back at the marginal rate on my tax refund the next year. But when I retire, you can make the argument that you should use the blended tax rate as the actual tax rate that you're withdrawing the RSP from. I think that is potentially true if we just consider the minimum withdrawals that you have to make from your RIF, because that is a fixed income. And so if you just think about the minimum withdrawals that you're required to make from a RIF in retirement, that's fixed. CPP is fixed, OAS is fixed, your defined benefit plan is fixed. Why are you selecting the minimum fixed income from the RSP as the income that's taxed at the marginal rate? I could make that argument, but at the same time, you have a choice with your RSPs. You have a choice to contribute to the RSP. Whereas you don't have a choice to contribute to CPP. You don't have a choice to contribute to your defined pension plan. So again, I'm not bought into that.
Like, does it matter though? Like, you've modeled this. You kind of know where the benefit of the RSP comes from. Is it that?
No, but
so that is not an argument. It's
not a real argument. It's not a real thing that I'm going to make. But it is really interesting because again, I have heard some people that I respect that are much smarter than me that have made a fairly compelling argument that we should think about it that way. And when they listen to this episode, I'm sure I'll have discussions with them about it because they'll tell me I'm wrong and that we should be using the average tax rate on.
Can you imagine that some people think we're nerdy?
But you can
a little bit.
You can just model it though, Mark. Like you can model it the way that you've done, and if there's some big magical benefit from using the average tax rate at retirement, you'll see it in your modeling.
It's just mental accounting, right? Like it's
so it's not a real thing.
I don't think it's a mathematical phenomenon. I think it's maybe a psychological one, right?
It makes people feel good. Like that's great. I love it. Awesome. But
yeah. No, fair enough. So, but going back to what you were saying, Ben, is when you earn income, you have taxes withheld, right? And so if you're earning employment income, you have taxes withheld on your paycheck. If you're earning even income from, say, dividends from your corporation, you're going to get put on installment payments, right? And so you are going to have taxes withheld at source in most cases. And so when I made this argument on Twitter about RSP returns being tax-free, a friend of mine who's an advisor reached out and said, yeah, I just don't buy it. People don't think that way because at the end of the day, you're going to have $10,000 in your bank account, and it's those dollars that you're making the decision with. Nobody's going to gross it up to $20,000 if they do the RSP contribution. They're not going to go and borrow money. They don't have an extra $10,000 sitting around. They're going to either contribute $10,000 to the RSP or $10,000 to the TFSA. And I do agree with that. And so I think from a mental models perspective, it's still unfair to obviously compare 10,000 in each of the accounts, but in practice, that's how people are going to actually allocate their after-tax dollars. But the interesting thing is when you make a $10,000 contribution to the RSP, in most circumstances, you will get a tax refund. And so the way I set the scenario up is that in the scenario where you're contributing to the RSP, you get a tax refund. And then you take that tax refund and you put that into the RSP, right? If we just think about the math on that, let's say you have $10,000 to contribute and you're in the 50% tax bracket again. If you put $10,000 into the RSP, the next year you're going to get a $5,000 tax refund. If you take that 5,000, put it into the RSP, the following year, year 3 now, you're going to get a $2,500 tax refund on that $5,000 contribution. You put in the $2,500, you're going to get $1,250, then $625, et cetera. And so over time, you are actually grossing up your RSP contribution from your starting point of $10,000 using the tax refunds and then the tax refunds on the tax refunds. Over about 8 years, you end up contributing almost the full $20,000 that you should have in the first place to make this an equal comparison. So the break even, you'll never actually hit $20,000, right? Like it just approaches 20,000 because you're halving it every time in this example, but you're going to get to like $19,990 or something like that in year 10. But by year 8, it's like 19,960 or something like that, right? So I think in practice, that is a more functional way to model out this scenario, right? We're not going to gross up the RSP. We're just going to use the tax returns.
So does that detract then from the RSP performance because there's a delay in investing the tax savings?
Yeah, I mean, there's a time value of money issue there, right? Like it takes you 8 years. Now, the majority of that comes in the first 2 years, right? So you put in 10, you get 5,000 and then 2,500. You're already most of the way to 20,000. It's just kind of the smaller incremental returns that probably have the bigger drag in terms of time, but less of an impact because you've got most of the money back in the first few years. But to your point, that's money that's sitting with the CRA essentially at 0% interest until you get that money back. So there is a return drag, I'd say, on that.
So the results then are going to understate the benefits of the RSP relative to someone who made a true pre-tax contribution.
Yes, in that
a bit, right?
Because the other way to make the pre-tax contribution generally is going to be to borrow the money, like an RSP loan or something. And there's going to be an interest cost to that, right? Because again, people don't have a pre-tax amount of money in most cases to actually contribute. They have to wait for the tax return to make it a pre-tax amount, right? Okay, so with that in mind, you've got scenario 1 where you're just contributing to an RSP, but you're using the tax refunds to gross that up over time. And then scenario 2 is just using the TFSA. So again, I started at $60,000 of income and I ran a scenario where they could only save, I did it for a couple. So there's 2 spouses, they're 25 years old in this example. They retire at 65 and they have $60,000 of employment income, no children. They're just going to work for the next 40 years. And each of them can only contribute $7,000 per year to one of the 2 plans. And I chose $7,000 because that's the TFSA limit for this year. And so if you have $7,000 in your bank account, you can put 7 in the RSP, collect the tax refunds, put all that in the RSP, or you can put $7,000 in the TFSA every year. And when I ran this at $60,000 of income, I delayed CPP for both of these clients. I delayed old age security. Most of the time we do planning for clients, we take them out to age 95 as the mortality age, which yes, is longer than life expectancy, but it is also the recommended planning from FP Canada. Which is the
25th percentile roughly of life expectancy, which is, like you said, it's kind of the best practices life expectancy to use.
Yeah, exactly. So I took both of these spouses out to age 95. Again, we delay CPP and we delayed OAS because in practice, that's usually or often the right answer, at least mathematically, and especially if you live to age 95, it's definitely the mathematically correct decision. When I did this at $60,000 of income, the RSP, the estate value of the RSP scenario at age 95 was $1 million higher than the estate value of the TFSA at age 95 in future dollars. Right now, we're inflating everything at 2.5% per year in this example. So we assume inflation is 2.5% per year. So when we're talking about $1 million of future value, like avocados are going to cost like $98 per avocado in that future scenario. So $1 million isn't going to buy you anywhere near the same as it would buy you today, but it was still a fairly impressive number. And at first I couldn't really figure out where the difference was coming from. Like I just thought I'd made a mistake somewhere. Like at $60,000 of income, I was quite surprised that the delta between the RSP and the TFSA was so huge. So I couldn't really figure it out. So I shot a couple messages to some of my nerdy advisor friends, our friend Aravind Sithamparapillai. Did I get that right,
That's
Ben?
it.
Yeah, you got it.
Nice. And another friend of ours, can't remember his name, starts with a J. James? JP?
Parsnip.
Pereira, I think.
Oh, yeah, Jason Pereira. Yeah,
that's it. Yeah.
Sure, Jordan Parsnip.
That's right. That's the guy. Anyway, so I ran it through with them really quick, and they jumped on a Zoom call with me right away, and we tried to figure it out. And Aravind is a huge tax nerd, and when he gets excited about planning, his brain just goes into like hyperdrive. And within like 10 minutes, he's like, no, I figured it out. And so what it was is I talked earlier about the basic personal amount, which everybody gets. It's basically a tax credit on the first $15,000 of income is essentially tax-free in today's dollars, right? Like today it's around I think it's exactly $15,000 of income that you earn is tax-free.
Yep.
But that's an indexed bracket. And so over time, if we index that $15,000 at 2.5% per year, in this example that I was running, by the time this couple is 65 and ready for retirement, that bracket, the basic personal amount, would grow to about $42,000 per person. And so that's $84,000 for a couple at age 65 that they could, in theory, earn without paying any taxes. And again, in this example, I've delayed CPP and old age security to age 70. So there's this window here of age 65 to age 70, where in the TFSA example, they have zero taxable income because they're withdrawing everything from a TFSA at age 65. And then CPP and OAS kicks in at age 70. So they have no taxable income from 65 to 70. But in the RSP example, again, I'm delaying CPP and OAS, but they have only taxable income from age 65 to 70. And so over that 5-year period, that's $420,000 of RSPs that can come out tax-free.
Right.
And that's really interesting because that creates a situation where the RSP, at least on that amount, becomes a pure tax flow through. Like it's zero tax. So you've got $420,000 of RSP money that you put in and got your taxes back. It's pre-tax money, but you paid zero tax. And the only other instances of that being available to Canadians is like the first home savings account. If you buy a qualifying home, is a pure tax flow through. The healthcare savings accounts for some small business owners and corporations up to certain limits can act that way. But there are very, very few opportunities to literally earn $1 and keep $1.
So it's straight tax arbitrage between your marginal rate when you made the contribution and zero in 40 to 49 years from now.
Exactly. And that chunk of the RSP coming out tax-free explained like 3/4 of the delta between the RSP and the TFSA scenario, which is really, really interesting. And so I thought, and Aravind pointed something out to me, and I don't really know how he figured this out, but he instantly said, oh, well, in that case, the RSP will always win, even at the lower bracket. He'll have to explain that to you because I don't know how he figured that out. I was like, what's he talking about? So I went back and I ran it at $48,000 of income instead of $60,000 of income. Because in BC, at least $48,000 is basically the top of the first tax bracket. And even at $48,000, the RSP was beating the TFSA. And it largely came down to this kind of basic personal amount tax credit. Essentially with the TFSA, you can't avail yourself of any tax credits. With the RSP, you have a chance to reduce your marginal rates even further in retirement because of the tax credits you get. And so you get this kind of dual benefit from the RSP in that sense.
Wow.
So the TFSA basically forces the high marginal rate when you made the contribution through your lifetime with no chance for any sort of tax recapture. Effectively, that's what's going on. Interesting.
Yeah, exactly. And so like the way I was thinking about it is, if you're going to delay CPP and old age security, in the TFSA only scenario, there's an additional cost to delaying CPP and old age security. Because if you were to take it at 65, you'd be able to use up that basic personal amount, those tax brackets with the CPP and OAS income at 65. So if you delay it to 70, the additional cost is that you're not going to be able to avail yourself of any of these tax credits. So it becomes more expensive almost to delay OAS and CPP in a scenario where all you have is tax-free income otherwise.
So the RRSP is a tax hedge.
Yeah, exactly. Now, when I ran it at $48,000 of income per person, I didn't think it was fair to use $7,000 of savings each, just because that income at $48,000 is kind of a starting salary for a lot of people. Being able to save $7,000 each per year is probably a relatively high amount for a lot of people. So I dropped the contribution to $3,000 per spouse instead of $7,000. But again, the RSP won in that scenario. So Aravind was right in his intuition that it would even work at the lowest tax bracket. No, it wasn't by as wide of a margin as the original example with 60,000, but the RSP did come out ahead. So like I said, then I tried to set in the TFSA scenario, I set 65 as the age for the CPP and OAS to try to soak up some of those brackets, but it was actually worse than delaying CPP. So they were able to avail themselves of that basic personal amount tax credit. But by taking CPP and OAS early or at age 65, they didn't get the benefit of the deferral, which increases those pensions for the rest of your life. So at age 95, taking CPP and OAS was still the right decision, which then got me thinking about, well, what if they die young? Like, what if they died at 80 and not 95? What would that look like? And so I started running these other scenarios with different longevities, and I'll get into some of the results of that as well. So at this point, I'm thinking, okay, the RSP wins basically every time. And then it occurred to me that at this point, conquest planning doesn't have the guaranteed income supplement built in, which we call GIS. So GIS, for those that aren't familiar with it, the guaranteed income supplement, it's a government support payment for Canadian seniors age 65 or older. And it's an income tested benefit, and it's really designed to help very low income Canadians. It's a tax-free benefit paid annually. Again, it's income tested, so there's a ceiling of income over which you don't qualify for the GIS at all. But it's also tied to your old age security payment. So you can't get the GIS unless you're also receiving old age security. The government of Canada has a really nice little calculator on their website where you can input your age today, your expected retirement income, your expected taxable retirement income, and it will tell you what it thinks you will qualify for in terms of the guaranteed income supplement. And again, in the TFSA scenario, from 65 to 70, they have zero taxable income because they're not taking CPP or OAS. But by adding in GIS, using that calculator, figuring out what the present value of their GIS would be, and then inflating that from 65 to 70, also taking old age security at age 65, because again, to get the GIS, you have to take the old age security. That drastically changed things. So at age 65, you're getting old age security. In this example, you're getting the guaranteed income supplement, which works out to about $7,500 per year, tax-free for those 5 years, per spouse. So we've got $15,000 of tax-free income coming in every year. And that's based on the fact that we have spouses here. If you're a single person, the ceiling's different. If you're a couple, then it's a different ceiling. So in the case of a couple, it was $15,000 of additional total household income for 5 years, from 65 to 70. That drastically changed things. So in that scenario, the TFSA came out ahead, but not by so much, like not as much as I would have thought. So in Conquest, we have something called a retirement score. And really what the retirement score is it takes the present value of your total after-tax cash flows in retirement, takes the present value of that, and just divides it by the total present value of your after-tax expenses in retirement. And so if you have a higher present value of income than expenses, you have a number over 100% for your retirement score. And if it's below that and there's a shortfall somewhere in the plan, you're going to have less than 100%, right? Obviously, we want to shoot for more than 100%. That means we're fully funded for retirement according to the model. So in the RSP scenario, with death at age 95, $48,000 of income, saving $3,000 a year, the RSP had a retirement score of 110%. So they were fully funded for retirement. That's using a linear rate of return. So that assumes the returns are earned equally every single year with zero volatility. I should also point out I used a 5.9% rate of return in all of these models, assuming an all equity portfolio, 5.9%. It's not our expected returns. This is the expected returns that comes off the shelf in Conquest. And when I ran the TFSA scenario, it was 113%. So the difference in retirement funding, even with the guaranteed income supplement, it was only a 3%, like an absolute difference of 3%. So I wanted to look at some other metrics. And so I wanted to look at what's the projected value of the estate. What's left over, net of taxes, net of probate fees, net of everything. What's the check that's going to the inheritors of this estate using this model? And with the RSP at age 95, it was the future value of the estate was $1.17 million. And with the TFSA, it was $1.76 million. That's future value, so quite a significant difference, right? In present value terms, it's about $100,000 difference. So in present value terms, we're talking about a $200,000 estate for the RSP and a $300,000 estate for the TFSA. A 50% increase, more or less, which is, okay, that's significant. But again, that uses linear returns. And if we Monte Carlo this, meaning if we say, okay, this couple retires 1,000 times, and they get a different return and a different order of returns in the retirement. It's not like a GIC where you're going to get 5.9% per year. We know the order of returns matters, and we know there's volatility on risky assets, and so you're not going to get 5.91%. What if we retire 1,000 times? How many times did we run out of money in each scenario, the RSP versus the TFSA? And what was really interesting is the RSP actually came out ahead in that scenario because it has to do with the old age security, which I'll explain in a second. But the RSP, the Monte Carlo pass rate at age 95, 59.4% of the time, they still had money left at age 95. So out of 1,000 simulations, 594 times, they still had money left. They had not run out of money. But with the TFSA, it was only 50, with the TFSA and the guaranteed income supplement, it was 60.7. So it was barely higher. And again, that is with the guaranteed income supplement. Without the guaranteed income supplement, the TFSA scenario drops down to 54.6%. So significantly worse than the RSP scenario. So there just wasn't a huge difference, even when you account for guaranteed income supplement.
So was that, you said OAS was the explanation for that. What does that mean?
Oh, yeah. So the reason that I think the scenario, even with the guaranteed income supplement, wasn't like light years ahead is because you're then forced to take old age security earlier than you wanted to, or earlier than would have been optimal. And so you're not getting the benefit of the old age security deferral because you're taking it at 65 instead of 70. So the lifetime income that you get out of old age security in order to get the guaranteed income supplement, you're getting less OAS over time in order to get the tax-free income from the guaranteed income supplement. Does that make sense?
I think so. I'm just wondering if the, because like when you run a Monte Carlo simulation, bad outcomes should be less bad for the RSP than the TFSA, I think, because you'll pay less tax. Like a pre-tax savings account should offer some amount of hedge against bad
that's interesting.
investment outcomes.
Because the government owns part of the RSP and they're paying some of the...
Effectively, yeah. If you lose in your RSP, you're reducing your future tax bill also. But the TFSA, you've already prepaid, right?
Yeah, makes sense.
That's one of the things that I think Scott Cederberg talks about that in his paper. We talked to him about that in the first time he was on Rash Reminder, about his paper on pre versus post-tax savings optimization.
But it just reduces the future tax liability, not the tax liability in the year that the cash is needed, because I assume you had a spending amount you needed in this plan. Mm-hmm. So if there's a shortfall, it had to take on more RSP to make up that shortfall.
Yes.
Right. No, it would have been fixed dollar because you had a gap. It just means you had less RSP at the end of that year, therefore reducing future tax liability.
Yeah, I think that's what it is. I think that, but if you just compare pre and post tax savings, I think the pre-tax account is going to give you some amount of protection against bad investment outcomes.
That's a good point, though, Cameron. I did use a $6,000 after-tax retirement target for this analysis because if you take two people earning $48,000 per year, back out taxes and CPP contributions, and then back out $3,000 of savings each, what's left is about $72,000 after tax. So that's their current lifestyle, is about $6,000 a month, and so I use that as the retirement target as well. So
the gap that was being used by the RSP to be filled, that tax liability in that year is the same. But to Ben's point, if you're selling more units to make that payment, there's less RSP later. If when the markets rebound, thus reducing the future tax liability because your RSP is going to be smaller, right?
So here's what in that Cederberg paper. It's the David Brown, Scott Cederberg, Michael O'Doherty paper, Tax Uncertainty and Retirement Savings Diversification.
Classic.
Classic. It is a good paper. It's in the Journal of Financial Economics. Traditional accounts, which in their case is, what are they called? IRA accounts, not the Roth, the traditional IRA. Traditional accounts are valuable for hedging retirement account performance and managing current year income near tax bracket cutoffs, whereas Roth, or TFSA in our case, accounts allow investors to mitigate uncertainty over future tax schedules. Somewhat related to the stuff you're talking about.
Yeah. No, I'm sure that plays into it. That's harder to, I think, tease out of.
But it should show up
model,
in the Monte Carlo though.
Yeah, well, the Monte Carlo just kind of gives me the score and the actual range, right? So it's not that I can look into every year of the Monte Carlo and see what's happening. I can just see the pass fail rate for that year. One of the other really interesting stats that this particular Monte Carlo shows is in years where you ran out of money, what was the largest shortfall in any given year? So when you did run out of money, how much were you short? And the RSP comes out ahead here, and I think this is related to the old age security as well, because if we look at the RSP scenario, again, the Monte Carlo pass rate was 59.4%. The largest shortfall in any given year was $31,000. So they were $31,000 short for their goal of $72,000 per year in income. That was the worst case scenario with the RSP. With the TFSA, even with the guaranteed income supplement, the worst shortfall was $59,900. So nearly double. And I think the reason there is that, again, because of the old age security being deferred to age 70, your minimum baseline income from 70 to 95 is that much higher. So your worst case scenario isn't as bad because you've got more old age security income coming in, and that's fixed and it's also inflation adjusted. Whereas with the guaranteed income supplement scenario, you're taking the old age security at age 65. So your minimum income floor is lower for the rest of retirement. So in the cases where you did run out of money, you had a bigger shortfall between your fixed income and what your goal spending target was.
Can you reiterate why there's a difference in timing on when you're taking OAS in the two scenarios?
Yeah, so in the case where you have guaranteed income supplement, it's tied to taking old age security. You cannot receive the guaranteed income supplement unless you are already taking the OAS benefit payments.
Okay.
So if you delay old age security to age 70, you can't receive the guaranteed income supplement.
Because it boosts your income too much.
No, because it's tied to the old age security. Like the qualification for a guaranteed income supplement, first qualification is you are receiving old age security payments. That's it. In fact, old age security income is not used when testing your income level for the guaranteed income supplement. So that income ceiling,
you won't receive it for those 5 years if you delay.
That's what I'm saying.
OAS.
Yeah, you won't receive any guaranteed income supplement if you delay
later. Okay, I get it.
Yeah. But you won't get the GIS later because now CPP comes in, and CPP is too high for you to qualify for the GIS.
Oh, so you take it early so you can get the GIS for those 5 years.
For 5 years. That's exactly what I'm saying.
Defer CPP.
And then CPP comes in. Yep. Okay, I understand now.
So CPP income is used to see if you qualify for the GIS. In terms of the income ceiling, CPP income qualifies. In this case, I used 66% of the maximum CPP because their income is $48,000.
Okay.
And that's about 66% of what we call the YMPE, which is their kind of CPP contribution ceiling. So in this scenario, by delaying CPP and only having a TFSA, they would, in theory, qualify for the guaranteed income supplement. The only way to get the guaranteed income supplement is to apply for old age security. And old age security income is not used in the test as to whether you have too much income for the guaranteed income supplement.
Crystal clear now. So you've basically modeled smart financial planning into the comparison.
Yeah, and now I think, and this is a question of morality, but there are planners out there who plan for their wealthy clients to try to qualify for the guaranteed income supplement for those 5 years. And I think that's pretty gross, to be honest. That's my personal opinion. I don't think the guaranteed income supplement is designed for wealthy people who just aren't paying any tax to get some tax-free income from the government. But I know planners who intentionally try to design things so they have zero income between age 65 and age 70 so that they get the guaranteed income supplement. On that point, I would not be surprised if the guaranteed income supplement somehow became TFSA tested in the future. So the government knows the value of our TFSAs. They get a transaction report, but they also get a report that shows the market value of people's TFSAs. And as TFSAs get bigger over time, and again, this is pure speculation on my part. No, CRA has not come out and said anything about this as far as I know, but I would not be surprised if people with mid 6 and 7 figure TFSAs who are trying to qualify for GIS. The IRA just goes, what's your TFSA balance? Oh, it's over X. You're absolutely not qualifying for the guaranteed income supplement for low income seniors. I'm sorry, right? Like, pure speculation, but especially, I'm 40 now, 25 years from now. Do I think the GIS will be there when TFSAs are in the 7 figures? I don't think so, but
be there for you. It'll be there for people with low incomes.
It'll be there for people with low incomes for sure. And I think,
and small TFSAs.
Well, exactly. Right. There'll be some threshold, I think, under which like maybe you can qualify, but I wouldn't be surprised because it's just not a far leap. They already have the value of your TFSA, right? And they can just look at your guaranteed income supplement application and say, do you qualify based on your TFSA balance, right?
And Ben, you and I talked about that on an episode a long time ago. We had a client that had that exact experience accidentally, and they were getting the GIS and they were stunned because they have rather large RSPs.
Right.
And their comment was, yeah, this is kind of gross.
Yeah.
Right.
Yeah. Like old age security has a pretty high income test. It's around, I think, like $90,000 now.
Yeah.
But GIS is really, really designed for people who are like below poverty level incomes. And it's a great program, but it's certainly not designed for people trying to game the system with the TFSA to get it right. Okay. So without the GIS, like if you believe what I just said and that, okay, maybe GIS is not going to be there for me, and now I still have to make the decision of a TFSA versus an RSP. In the scenario where there's no guaranteed income supplement at age 95, the estate value, the future value of the estate with the TFSA was $659,000, and the retirement score was 105%. And again, with the RSP scenario, the retirement score was 110%, and the estate value was 1.17 million, so nearly double the estate value. So the GIS really was the entire difference maker between the RSP and the TFSA in that scenario.
Mm-hmm.
Yeah. Which kind of leads you to think, okay, well, even at $48,000 of income, then your decision as to whether to contribute to a TFSA or an RSP largely comes down to your belief as to whether the GIS will be there for people with large TFSAs later.
Didn't see that coming.
Shows you why you can't do it on the back of a napkin. A little too complicated.
Yeah, for sure. And again, I tested things like moving CPP and OAS around to see if we can improve the situation. But the best scenario for both cases, TFSA and RSP, is deferring CPP and old age security. And only with GIS did I have to pull the old age security back to age 65, which actually detracted from the OAS income, but at least gave you the guaranteed income supplement. So then that got me thinking as well about what if you have kids? And the reason this I think is interesting is because if you have kids, you qualify for the child care benefit. And this is an income tested benefit as well. And it's based on the number of kids you have, and it's based on your income. But I said, okay, well, if we contribute to RSPs, we're lowering our income, and we would qualify for more childcare benefits that way. So what if we ran a scenario still at $48,000, still saving $3,000 a year to one of these accounts, but we added 2 children? How would that impact things? And when we got the childcare benefit, when we received that payment, we saved that money as well instead of spending it.
So sorry, this is the Canada Child Benefit?
Yeah, sorry, yeah.
Okay.
Yeah, the Canada Child Benefit. And it can be pretty significant. Like so I ran a scenario where they had 2 kids at the parents' ages of 30 and 32. So they start at age 25, but at 30 and then age 32, they have 2 kids. Again, their income is $48,000. It goes up by inflation. So for years and years and years, they get the Canada Child Benefit. And in some years, it was as high as like $12,000 of benefits that they were paid. So it can be quite a significant amount. And I set up the scenario so that in the TFSA scenario, as much as possible would go to fill up their TFSAs if there was still room available. If there was no room available because they'd maxed it out, the excess would go into a non-registered taxable account. And then I did the same with the RSPs. So if you're contributing to the RSP, you get the Canada Child Benefit. That goes into their RSPs, up to their RSP room based on their previous year's income. Any excess goes to a non-registered account. I wanted to see what difference that would make, because in the RSP scenario, you would get more childcare benefits or Canada Child Benefit, right? Because you're lowering your income even further with the RSP contribution. And because the Canada Child Benefit is income tested, your income is lower, you get more of it, right?
And it all comes back to your effective tax rate, right? Like this is another form of it's a government benefit, but when you reduce your income when you're eligible for this, you're not only reducing your taxes based on your tax bracket, you're also getting a boost in the Canada Child Benefit, which ends up being like I don't know what the numbers are, but a massive, in percentage terms, reduction in your tax rate.
Yeah, it's huge. Like I said,
Right.
in this case, there were years where they were getting $12,000 in Canada Child Benefit on on a combined household income of 96. So you're looking at like a 15% benefit based on the income that you have. Yeah, it was huge. And so this obviously pushed the retirement scores to astronomical numbers because you just went from saving $3,000 a year to your RSPs to saving, $6,000 to $7,000 per person to your investment accounts every single year. And it does improve the RSP scenario. The TFSA the TFSA with the guaranteed income supplement still wins out at age 95 in this case. So with 2 kids, the RSP retirement score was in excess of 150%. And unfortunately, Conquest kind of just truncates it at 150%. It says if your retirement score is over 150%, we're not even going to tell you what it is. It's just so high. So I don't know if it's 692% or 151%, but it was above 150%. But if we look at the estate values with 2 kids in the RSP scenario, the present value of the estate, so in today's dollars, was $1.146 million. With the TFSA scenario, with 2 kids and the GIS, it was 1.166. So it was a $20,000 difference in present value terms, which just isn't that huge, right? And again, that's using straight line returns. If we Monte Carlo it, the RSP with 2 kids, the pass rate in the final year at age 95 was 81.9%. The TFSA with GIS was 79.4%. So you actually had a higher probability of meeting your retirement goals with the RSP versus the TFSA and the guaranteed income supplement when 2 kids were involved because of the additional amount I think that you could save to RSPs. Without the GIS, that pass rate score dropped to 76.5% for the TFSA, and the estate value dropped to $5.68 million in future value, which is $983,000 in present value. So without the GIS, the TFSA scenario was easily the worst of the scenarios that I ran. And again, the shortfalls were bigger. Anytime across all the analysis that I did, any single time you had to take the guaranteed income supplement, the worst case scenario was worse because you have to take old age security earlier.
Wild.
It is pretty wild. I won't go too far into the details on the other scenarios I ran, but I did test mortality at age 80 and then also age 105. And yeah, I get it. Like the probability of living to 105 is pretty slim. But again, we're talking 2 25-year-olds here. Who knows what the future looks like, what our life expectancies are. But if you do live a long life, and we don't know in advance what's better, the RSP or the TFSA, if you die at 80, the RSP becomes generally worse because you have a larger embedded tax bill that's getting taxed at a higher marginal tax rate. So you're dying with a larger RSP balance if you die young.
That's actually really interesting. Yeah.
Yeah. So with no kids, death at age 80, RSP retirement score was 121%. Present value of the estate was 162,000. In the TFSA scenario, with no kids and the guaranteed income supplement, it was retirement score was 2 kids and the guaranteed income supplement. Yeah, retirement score was well over 150%. Present value of the estate was 841,000. Versus 162 for the RSP, so a multiple of nearly 4.5 times. Monte Carlo scores were far greater for the TFSA in that scenario, 90% versus 66%. But the largest shortfalls were still worse for the GIS scenarios there too. So basically what I came to at the end is like the decision between the RSP and the TFSA has probably less to do with your marginal tax rates today and has more to do with your belief in whether the guaranteed income supplement will be there for people who have TFSAs only. how many kids you're going to have and how effectively you can save any government benefits you get in terms of reduction in taxes or income from the government. And lastly, when you're going to die. Those three factors, it seems to me, are largely more important than what your income is.
Wild.
Mm-hmm.
Pretty interesting stuff. So there's a bunch more I want to do, but
what's the main takeaway? Like, how does this affect advice you give to a client, for example?
Yeah, so, and I mean, that's why we model every client scenario, their individual scenarios, right? Because everybody's different, and obviously we don't know a lot of the variables I'm discussing, like will GIS be there and when are you going to die? Like if you tell me when you're going to die, I can design the perfect tax plan for you. But in the absence of that, we have to make some guesses, right? But we do a lot of scenario testing, right? And so we can kind of see what the outcomes are. And we should also point out, like, the TFSA is an amazing account. It's super, super flexible. The tax certainty that you get with the TFSA, you already paid your taxes. You never have to worry about taxes again. With the RSP, you don't know what your future tax rates are going to be or what everyone's future tax rates are going to be. So I think the trade-off, even if the RSP is mathematically better, the flexibility that's built into the TFSA is excellent. I don't know that I have a rule of thumb, but I would say even at lower incomes, like, you probably want to look at or at least model using both accounts or splitting it, right? Like half to the RSP and half to the TFSA. It depends on your goals. Like, I'm talking about retirement money here. So like if you're going to buy a house next year and that's what you need the money for, of course, that's a totally different discussion. But if we're talking retirement money, it becomes, I often make this decision or encourage people to make decisions when there's that much uncertainty and one outcome is definitely going to be better than the other and we just have no idea. And you're choosing between two things, do both, right? And then anchor to the one that worked out the best so that psychologically you feel good. Like even market timing, lump sum investing, that kind of stuff. Invest half now and then invest half later and then just anchor to whichever of those two pots did better. It's kind of one of those scenarios, I think.
Mm-hmm. Super interesting.
Very cool.
I don't know. What do you think, Ben? What do you think investors should do with that?
I think what you said makes a lot of sense. And I think people in low tax brackets, or middle tax brackets that are constrained in their ability to save, so they can't just max out both accounts, which is probably ideal if you can. I think having some mix is probably the right thing to do, whether it's 50-50 or some other amount. I know that's also in that Scott Sederberg paper that I mentioned earlier. They found, I think people with low taxable incomes should just use the TFSA in their paper. And otherwise, they had a rule of thumb. I think it was age plus 20% go into a traditional account, and the rest goes into a Roth or a TFSA. So they totally different approach to what you're talking about because they were modeling tax rate uncertainty based on historical U.S. tax rates. But they come to a similar conclusion on having a mix of both account types for where you should be contributing. So I think if there's one big takeaway from your analysis, and then to line that up with the Sederberg stuff, it's that maybe it doesn't make sense in any case for somebody to focus solely on one account, which is often what you see online. Oh, well, you have a low income, you should only use this account. That may not always be true or correct.
Yeah, and people, obviously there's contribution limits to both the RSPs and the TFSAs, but when you have a fixed amount to save, again, you're looking at a fixed amount that's in your bank account. You don't need to fill one before the other, right? Like you can split that deposit and whichever weighting you want and be funding both, right? So it's not that you have to fund one and then the other. It's not like some sequential order of events. You can simultaneously fund both of them in some different weights, right? So,
and I agree. A lot of people may not have the income to be able to afford to maximize both, but a lot of people do have the income and don't maximize both.
Sure.
And the amount, it just becomes a nice beacon to strive for each year to keep everything maximized.
Yep.
Right? They're for many people, it's not that out of reach. Yes, you'll have to make some spending choices to have the cash flow, but that's what this is, right? Deferred gratification. Instead of spending it now, put it into one of these accounts. And I just find the amounts they're just so nice and clean and strive to do it. And if you do that, you're going to have a pretty good nest egg at the end of the day.
Another takeaway might be that the differences weren't huge, right?
At 95, they were pretty small. Like
So someone
at
agonizing
95,
over,
it was largely a coin flip.
yeah. So someone's agonizing over which account to contribute to, and that's causing them not to save or to delay saving because they've got some analysis paralysis.
Yeah.
Maybe it doesn't matter that much. Just put it somewhere.
Yeah, and I didn't get into the details, but the death at 105, the death at age 105 scenarios, the RSPs got substantially better than the TFSAs. And so the longer you live, the better the RSP looks versus the TFSA. And the other thing I should mention, I didn't mention this out of the gates, is in the RSP scenario, if there's additional like excess income that's above their spending needs in these scenarios, I'm funding the TFSA in retirement, right? So like we've got the $6,000 retirement income goal after tax. But when you delay CPP and you delay old age security, and then you've got a relatively large RIF balance, your fixed income, in the scenarios I ran, the fixed income that they were bringing in after tax exceeded the $6,000 retirement target. So they had excess cash. So this wasn't like trying to maximize their spending. This was with a fixed $6,000 a month spending throughout retirement. And when there was excess cash, that did go into a TFSA. Just not at all while they were working and contributing. So I did that. That was across all three scenarios, all age groups and everything. But the death at age 105 scenario, the RSPs became substantially better, basically in every single case. So it seems to me if you die young, the RSP is worse. You have a bigger embedded tax bill. The longer you live, the more you get to spread that tax bill out, and the better the RSPs become. So from that perspective, the RSP becomes a little bit of a longevity hedge, I guess, versus the TFSA only strategy.
Whoa. That's wild. Makes sense though, because you've got more years of low tax brackets to spread out that income.
Yeah.
Really, really interesting.